Tight liquidity or buying liquidity. Tight liquidity occurs when there are more buyers than sellers. This creates upward pressure on prices as buyers compete to purchase the underlying asset. It is referred to as buying liquidity and is represented in green.
Tight liquidity or buying liquidity. Here's an example in the SPX. When demand for an asset increases and the number of buyers exceeds the number of sellers, prices rise as the buyers compete for limited supply. Here we can see in the green that we have very strong buying and very little selling here in the red. And because of that, we can see that prices increase.
Loose liquidity or selling liquidity. Loose liquidity occurs when there are more sellers than buyers. This creates downward pressure on prices as sellers compete to attract the limited number of buyers. It is referred to as selling liquidity and is represented in red.
Loose liquidity or selling liquidity occurs when there are more sellers than buyers. Here we can see we have balanced liquidity. As more sellers arrive than buyers, the indicator turns red and the price declines.
Surface liquidity. Our model of surface liquidity measures the current buying or selling activity within the closest time periods on a chart. It compares how tight or loose liquidity is in the current period relative to the 5 previous periods. These 5 comparison periods range from the closest 8 previous periods and out to 500 previous periods. This creates a time-layered effect, similar to a moving average principle. When buying begins and prices start to rise, additional buyers may join in, further driving prices upwards. This surface liquidity drives prices up as new entrants fear missing out, or FOMO. Similarly, when selling begins, late sellers may react, accelerating the price drop. The selling process can happen quickly as sellers rush in, fearing a declining market. Surface liquidity reflects short-term market activity and highlights how buying and selling pressure can quickly influence price movements.
After an accumulation or distribution event, surface liquidity takes over. Surface liquidity is the liquidity that affects the direction of a security or commodities in short time periods. This could be buying with and supporting the prevailing price appreciation or selling into a pullback. It can also be seen as a pause in direction as buyers and sellers are exhausted. Surface liquidity either adds to or subtracts from the overall liquidity as more buyers decide they want to buy, or depletes it as holders decide that they are going to sell. A lot of surface liquidity can be accounted for with dealers and market makers needing to flatten their deltas of the positions they have traded as prices rise or fall. This is especially the case for option dealers. When the market participants don't think the current price of a stock reflects its value, only a small number of transactions need occur to continue a trend in price. Understanding this, as with all liquidity, it is important to remember it is the ratio of buyers to sellers that drives price movement. In the case of surface liquidity, although there may only be a few transactions, if the ratio is weighted heavily to one side, the price trend will continue. Our model of surface liquidity measures current buying or selling activity within the closest time periods on a chart. Here we can see that the thickest line is the current or closest period, and the furthest away period is the thinnest line. Here the surface or closest periods see strong buying in green, and here the surface or closest periods we can see strong surface selling. Here we can see very strong surface buying with most of the time period lines converging before the surface liquidity rises, becoming loose, as we see strong selling and eventually a price pullback.
Liquidity. Tight liquidity or buying liquidity, more buyers than sellers, leading to price increases. Loose liquidity, selling liquidity, more sellers than buyers, leading to price decreases. Surface liquidity, short-term buying or selling activity that measures how tight or loose liquidity is compared to previous periods and is seen in the context of a larger time period of change in one direction.